What is a share price? A share price is the current value of one share in a company. But here's the key thing. Share prices aren't fixed. They're always changing based on what people are willing to pay. It's a bit like an auction. If lots of people want to buy, the price goes up. If more people want to sell, the price usually falls. Why does it matter? Understanding why share prices move helps you stay calm during ups and downs. It reminds you that the price dropping doesn't always mean the company is doing badly, and a sudden rise doesn't always mean it's time to celebrate. Once you understand the why behind these movements, you're much less likely to panic when things dip, or get swept up in hype when they spike. It helps you think long term. Here's a simple example. Take Apple. Let's say Apple reports record-breaking iPhone sales and announces a brand new product, like augmented reality glasses. Investors get excited because they expect even more profit in the future. As a result, more people rush to buy shares, and the price rises. Now imagine a different scenario. A major supplier suddenly goes bankrupt, delaying Apple's next product launch. Investors might worry that earnings will fall short, so they start selling shares. That wave of selling lowers the price, even though the company is still huge and profitable. It's not always about what Apple is doing today, it's about how investors feel about what might happen next. Is a lower priced share really cheaper? Not always. The price of a single share doesn't tell you how expensive or cheap a company really is. What matters is the market value of the whole company, called its market capitalization, or market cap. Here's an example. Company A has 10 million shares, each priced at £10. Its total value, market cap, is £100 million. Company B has 1 million shares, each priced at £100. Its market cap is also £100 million. Both companies are worth the same in total, even though one share in Company A costs £10 and one share in Company B costs £100. That's why a £5 stock isn't automatically a bargain, and a £500 stock isn't automatically expensive. What matters is the overall value of the company, how much profit it makes, and what investors expect for the future. Companies can even split their shares, for example, turning one $100 share into 5 $20 shares, without changing their actual value. The company is still worth the same amount, it just has more shares trading at a lower price each. So when you're looking at share prices, it's better to focus on the big picture, the company's size, earnings, and potential, rather than just the dollar amount of one share. What else should you know? Share prices are influenced by many things. Some are logical, others emotional. A company's performance plays a big role. When profits rise, or a company launches something innovative, prices often go up. But if it posts losses or runs into legal trouble, the price can drop. Still, even good news isn't always enough. If a company does well, but not as well as people hoped, the price might still fall. Expectations matter. The wider economy also plays a part. If interest rates rise, borrowing becomes more expensive for both companies and consumers. That can slow business growth, so investors might sell shares and move their money into savings accounts or bonds, which start looking more attractive. Then there's the general market mood, called sentiment. During times of uncertainty, like political unrest or a recession, share prices across the board can fall. Even strong companies get caught in the wave simply because people are feeling nervous, and sometimes the movements don't make much sense at all. Share prices can swing on rumours, headlines, or sheer emotion. People are human, and markets reflect that. In fact, many trades today are made by algorithms, computer programs that react to news in a fraction of a second. This kind of trading can make prices move even faster, especially during breaking events. One more thing to keep in mind, the share price doesn't always reflect the true value of a company. Sometimes it's overpriced due to hype. Other times a great business might be overlooked and underpriced. The market is driven by expectations, not always current reality. To sum it all up, share prices go up and down because people constantly change their minds about what companies are worth. It's a mix of logic, emotion, and sometimes just noise. That's why long-term investors often don't worry about daily price swings. They know that value takes time to show, and staying calm and instead thinking long-term is often the smartest move. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.